Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest signs of panic on Wall Street and ask, what does it mean for us? And we'll check out how much local governments are charging us in rates, fees and fines. It's a lot and it's getting bigger fast. But firstly, we look at the latest news from Credit Crunch Central, Wall Street. Late on Sunday US time, America's fifth biggest investment bank, Bear Stearns, was sold in a fire sale after a few rumours essentially triggered a run on the bank and threatened to empty its coffers within days. JP Morgan bought Bear Stearns for $236 million. Now that sounds like a lot, but it's not. Bear Stearns was generating annual revenues of $6 billion. It was worth $3.5 billion on markets just 4 days ago. Essentially, the US Federal Reserve has decided to sacrifice the shareholders of Bear Stearns to ensure an investment bank does not go into bankruptcy. The situation on Wall Street is extremely serious. For the first time since the Depression, the US Federal Reserve has started lending money to brokers, not just to banks. So what does this all mean for us here in New Zealand? It means that our interest rates will go up or be higher than they would otherwise have been, and for longer. And inflation will rise. That's because the US Federal Reserve is pumping cash into the global financial system like there's no tomorrow. Gold and oil prices are rising because people are worried about inflation. We've already seen New Zealand mortgage interest rates rise 0.5 percentage point since last June when the subprime credit crunch started. So the 2-year rate on the fixed mortgage is now up from just under 9% to 9.6% or so. This global financial crisis is different from the last ones in that we care a lot more now about interest rates than we do about share prices. Now, only about 31% of our assets are in shares and bonds. Back in 1986, before the 1987 crash, that percentage was over 50%. Now, we care a lot more about our mortgage debt and house prices. That's because 69% of our net worth is now tied up in our houses. And our mortgage debt has blown out to $160 billion from $26 billion in 1986. So we care about interest rates. They are rising fast on anything that is not a US government bond. The gap between New Zealand 1-year wholesale interest rates and US interest rates has blown out to 7.2%. We can expect our mortgage rates to either rise or not to fall when we would otherwise have expected them to fall as the economy slowed. That's what this all means. Now for a quick look at another angle on the inflation story. Government fees and charges, or more particularly, local government fees, rates and charges. They rose 11% in the December quarter to just over $1 billion. That's up from a year ago. So local government rates, fees and charges are rising 3 times faster than inflation generally. The biggest driver is local government employee costs, which rose 9.1%. This is because of a jump in employment in local government as central government shifts more responsibilities to local government and as regulations such as building regulations and the Resource Management Act require more and more bureaucrats. No wonder the Reserve Bank has an inflation problem. This is one of the reasons interest rates can't be cut. On that cheery note, I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Wednesday.